Hello and welcome all to today's yearly Drooms Real Estate Trends in 2025 webinar. Thank you for the numerous attendance. And before we start, just a quick note, you have a Q&A function that is above, just right next to the chat function. If you have any questions, don't hesitate to pass in there, and we will try to cover them over the course of the webinar or at the end of the webinar. So we are looking forward to your questions. Now let's jump right in. As real estate markets in Europe are shifting due to global insecurity or changing demand, we will try to provide you with exclusive insights into the last year's biggest trends and share some predictions for 2025. And first, let me introduce our distinct experts. First, we have Christiane Conrads, partner at PwC, Timo Tschammler, executive partner at TwainTowers, and our host, Alexandre Grellier, CEO of Drooms. Welcome and great to have you.
Thank you very much.
I want to start with some of the macro trends regarding the transaction market. Drooms research shows that the duration of transactions is increasing year to year over the last years, and in Europe alone, it increased to 363 days for a deal. That's 19 days more than the year before. And German deals even need more time, 405 days compared to 374 in the year before. And UK is the sole champion for deal misery with 499 days. For the three of you, what are the main factors for delays and what risks do investors face with prolonged transaction times? Christiane, do you dare to start?
Yeah, thank you, Jasper, and also thank you to Alexandre and the Drooms team for inviting me today. Looking forward to the discussion. So maybe just a few comments on my background. So I'm part of the sustainability team at PwC. I lead a global real estate sustainability practice. And the input I would like to give today is really through the ESG lens. So what we see really in transactions is that the ESG due diligence has become an integral part of the standard transaction due diligence process. And what I think is really important to do is our gap analysis towards your ESG or sustainability ambition level in the in the due diligence phase. And so we see also there are of course more documents that need to be reviewed. And what I think is really important here to do it early. But I think also when we look at it from an international point of view, we conducted an international investor sentiment interviews a couple of months ago, where we spoke to like private equity companies in the US, insurance companies, asset managers in Singapore, and then Japan, and asked them, okay, what do you need from an ESG perspective to invest in Middle East real estate projects? And the focus country at that time was Saudi Arabia. And what we learned there was really interesting. So of course we need clarity on the legal environment. So of course, what are the building requirements, and will I be really entitled to get a building permit when I fulfill all the obligations, the requirements? But from an ESG perspective, what we learned there was also really, I think promising. Of course, anybody's looking at climate change mitigation, climate change adaptation. That means you need to get that right. And otherwise, there's a cost involved if you don't. And then what also was really interesting, even when we spoke to players, for example, with no European when no European parties were involved, like pension funds from Japan investing in Saudi real estate market, we see there is really that the highest standard wins, and that is right now the EU regulation, coming from the Green Deal, the EU taxonomy requirements, for example. And what we saw there, that's really, I think was really promising, that even if Japanese pension funds looking for real estate investment in the Middle East insist on the fulfillment of the European taxonomy regulation. And that, of course, requires more time in the due diligence process.
Timo, do you see any risks in the transaction process due to the rising transaction times, be it price fluctuation or deal security?
I think overall, the old rule counts again one more time, which is time kills deals. Yeah. So the longer a deal negotiation, due diligence, a process like that takes, we often the worst for the closure of a deal. However, when I saw the numbers, I was not surprised that deals do take longer in the current market environments. However, I slightly disagree. I don't think that the majority or the biggest source of that delay comes from the field of additional regulations or additional focus on ESG. Yes, that plays into the days needed to conclude a transaction. But from what I see, where really time is lost immensely is on the financing side and on the capital stack. So where it was substantially quicker in the past to arrange the senior capital, to arrange mezzanine or equity equivalents, that really now eats up time. But this might not count so much for last year, but definitely for the year before, 2023, to get consensus between seller and buyer regarding a price which will enable the transaction overall is a very difficult field as well. So that would be of interest to me. How many days are lost in those categories? Get the capital together, prove it to the seller that you have a stable capital base and can move forward. Because the big hope that pure equity buyers would be the saviors of the market did not materialize. Yes, you do have equity buyers, but their numbers are not big enough to turn the markets around. And then last but not least, second surprising point to me is that in the UK, with nearly 500 days, we have the longest duration. And why is that surprising to me? Because when it comes to price mechanisms in the UK, it's market to market, right? So they are not bound like, for example, the German open and public funds to the valuation regime here in Germany. They normally, so same in the US, they correct prices substantially quicker after market price corrections, which then enables the unlocking, let's say, of PUT situations in these markets on corrected price levels. Hence surprising that in the UK the longest duration is still needed.
Could it be due to economic insecurity following Brexit?
Definitely. In the UK, it's Brexit. In Europe, you had political question marks arising on the horizon as well. Same looking at the German elections, which just happened. When you speak to international investors, what they think about the former safe haven of Germany as a target investment market, you do hear such arguments, definitely. Yeah. And I don't think that will stop super shortly.
Alex, you nodded before on the longer financing times. What would you say to an investor? How could they mitigate against those deal risks originating in longer transaction times?
Well, just coming back what the two of them said, it's like for us, I mean, we are the platform facilitating the deal, right? So what we see and what we measure is a volume of data going into the platform. We measure the time it takes until there's a closure. We look whether or not there's closure and so on and so forth. So these are the things that we see. What we see as well is like the complexity of the structure itself. So while years earlier, I remember times where there were like deals coming within 2-3 weeks, and then like whole portfolios shifting from one owner to the next, then have been filleted and then have been sold again, and all this within a month, right? And so during those times, what we have seen is that the amount of data was significantly lower than what we see today. Today, we're not seeing more data and more information inside these platforms, but what we see is a bigger complexity with regards to the index itself. So goes into direction of Christiane with regards to ESG, more requirements, more requests for documentation, which we see definitely. However, is that the reason why the deal is not flying? I don't know. It's like if I talk to the people we're having as our customers and those who are investing and using our data rooms, what I constantly hear is like, okay, there's a huge gap between ask and bid. So as long as this gap is not sort of going away, the investment is pretty tough. So it might come from the financing aspect. It might come partially. Actually, I have seen it less and less in 2024 from the ESG requirements. So this has been, in fact, from what people have told us, it's like, yes, we need to provide the documentation. We need to provide the information, definitely. But is that the reason why investing or not investing? At least a lot of people I was talking to said, no, that's not really the reason. It's really the price, the ask and bid gap. Does it come from ESG? I don't know. That's not my role to have an opinion on that. I guess that the two which are with me on the panel can elaborate much better on that than I can do. But I can tell that the complexity has grown tremendously.
Timo, just quick question. Could solving the data mismatch, could that solve the ask and bid gap?
Honestly, I don't think so. I think if you ask buyers and sellers in the current market, tell me why did the last transactions you wanted to conduct did not fly, I doubt that you will hear data mismatch often as a top reason. I don't think so. Yeah, if you have a willing buyer and a willing seller who have common ground on the asset, on the transaction structure, and on the price, they will find ways to bridge data and information gaps hand in hand. Yeah, so there might be exceptions where a deed or anything else with comparable weight of documentary power is missing and simply needed, and you can't conduct the transaction without it. That might be an exception. But since we started the conversation coming from ESG and additional regulations across the countries, I doubt that will be a top reason. I think top reason will be no common ground, finding a mutual price agreement, and then second place, what I said earlier, it'll be the capital question. If you ask the big players these days, they will tell you there are more opportunities than capital, and that's a quote. That's not me. That's not me inventing that, but that's what they tell you, definitely.
Great. You just mentioned ESG. We spoke about ESG, and speaking of ESG and regulatory measures that increase complexity and duration of transactions, maybe next to the ask and bid gap, we have also pulled some numbers regarding the transaction complexity, and we pulled the numeric of data volume involved in a transaction, and it increased from 3 gigabytes 2023 to 3.6 gigabytes, which is a 20% increase, which is quite significant. And taking that as a sign of raising reporting and data requirements for the transaction process to conduct successful deals, I would ask Christiane, how are you and your customers handling those increasing requirements?
Yeah, thank you. Yes. So I think also when to ESG and increasing requirements by regulatory bodies. I think what there is really important is that the overall trends are pretty clear. Also the geopolitical trends are clear. We all see the global frameworks like Global Biodiversity Framework, the Paris Accord, and so on. And so it's really the direction is clear. And even though we speak about omnibus initiative and also the current discussion in Europe where we see less acceptance of more regulation, and it's about harmonizing, simplifying, finding uniform standards for 27 member states. That is tricky. So, but when it comes to regulation and those, I think clients who are really well positioned, they've started a while ago to look at ESG and then know the overall trends, and they're pretty clear. And also, they have a certain good understanding of what kind of regulatory requirements will be implemented also in the future. So that helps them a lot also in the due diligence process, and also to really to manage and develop also, for example, some projects to their benefits, also their financial benefits. What I think has changed right now, so you're not, when you look at the buyer's perspective, you're not looking on your own holding period anymore. You also look at your future exit and also need to understand what your future buyers have kind of expectations when it comes to ESG requirements. For example, we now see all the various value-add players with a managed to green approach and things. So they need to also look at the institutional investors with very high ambitions, for example, when it comes to ESG, you need to factor that in. And you also see, and I think, and the discussion before this webcast, for example, what we see in particular with project development, there is, before you have also the building laws in place, the building permit in place, the master plan, what we see there on really in the different cities and urban areas is that more and more building authorities, cities, are implementing more and more regulation, for example, when it comes to biodiversity, protection of ecosystems, and so on. And more of that regulation will come. And so I think everyone is really well prepared to look at the overall trends and see what is my ambition level in this regard. And then I also get an understanding, for example, on what I need to do until I get everything in place for the development phase.
May I throw in a question in your direction, Christiane, playing the devil's advocate to steer things up a little bit, maybe. When we say, or when you state there will be more to come, more regulations to come, that sounds very sure, right? So couldn't be the elephant in the room that there's not more to come because Trump and the new US legislation is pushing back in the opposite direction, and maybe other continents, including the EU, will have to follow?
Yeah, I think to some extent that might be right, but I think the overall direction is clear. And also, I think when you look at ESG, it's not a trend. It's one of the biggest transformation we see globally happening, and it won't go away. We can label it differently. But climate change is happening. We won't achieve the 1.5 degrees of the Paris Agreement by far now. So biodiversity loss, nature crisis is happening. So looking at the real estate industry, who is responsible for 30% of the global biodiversity loss. And also looking at concerns regarding resource scarcity things. So I think we need to deal with these physical changes, the physical risks that are materializing globally. And then even when we see less regulation, we need to find a solution for these risks. And so we I think it's also what the platforms on sustainable finance said. So they intended the regulation in Europe also as guidance to the market. When they see now less acceptance in the market and they step back, but then they leave it to the market to find solutions for the materializing risks. So that's something depends if we want that or if we don't want that. But looking over globally, also when we still discuss CSRD. So this is really not only a European trend, even though it might be was a bit too ambitious to start with. But China, for example, is right now also implementing a CSRD, which really follows the European model. We also see in 2 US states, in California and New York, for example, they are also having disclosure regulations on climate change adaptation and mitigation, for example. So even with all the geopolitical discussions we right now, I think, so these happening, and as a consequence of physical risk, I think we will see that regulation.
Yeah, it's interesting what you say, because I heard similar things than what Timo just said. It's like I have a couple of sell side data rooms which have been closed without any success, because the guys who wanted to sell and who advised the sell side said they are usually talking to investors from the US, and the investors from the US they are fed up with all these regulations in Europe, and so there's a huge trend. I mean, we've seen it with Elon Musk, who is now the Mr. Deregulation and Mr. Anti-Deep State, and you name it. But so that this has a massive impact on whatever we want and what we are driving as Europe, not as Germany, but as Europe within ESG. So there's a lot of voices in the market that I hear, at least, which say that this can have a very counterproductive impact compared to what we have been compared to the road we have been following right now. So this is interesting to hear your opinion on that.
It's actually, I can add that this trend is measurable already. So if you speak to the big capital raisers for real estate products, they will tell you that from the international capital sources, a lot of liquidity is sucked up by the North American growth story, which might now materialize or not, we will see, but at least the storytelling works. And that international investors and huge capital pots follow the song of that potential growth fantasy. So let's see. But sorry, I didn't want to steer it too far out of your agenda. Yes.
But no, I want to tap in just quite quick. Christiane, could it be that CSRD and compass strategy of the EU, which is pretty much building a sustainable economic superpower and also protection of the market against outbound concurrence, could it be that the CSRD leads to a easier or more transparent regulatory regime, because it's kind of a meta regulation?
Yeah, I think that's what we're actually seeing right now. Of course, it's So I've been working in ESG in the built environment for almost 15 years now, and it is always going like that. So it's been progress, and then it's been setback again. You need to be patient, I think. And also when we look at the CSRD, also what Europe has done here is it just has really, I think the European Commission and also the specific regulatory bodies, they looked at global reporting standards. At CESB, ISSB, GRI, GRESB. We also at PwC, we tried like 2 or 3 years ago, we got an appointment by ULI, INREF, and UNPRI to map global reporting frameworks and to see where do you have duplications, where do you have efficiencies, the thing. And what we learned when we conducted the mapping exercise, it's just not really possible. There are not so many duplications, and the devil is in the detail. And you really need to understand why you are reporting some information to whom and why that recipient of the information needs that requirement. And so that was really, now we progressed, I think, 2-3 years. I've been, we are now 2-3 years later, and with the CSRD, the EU really applied also methodology, which is well accepted globally. We see more and more players also in other regions, again, in the Middle East. We have just conducted a materiality assessment, double materiality assessment, to really assess sustainability risks, impacts, and also opportunities, and without any obligation to disclose the report after CSRD. That's also what we see in other regions right now. So at least conduct a double materiality assessment, because then you approach the ESG topic from a methodological point of view, which is also important for banks when it comes to sustainable finance and so on. So I think it's, even though 1,500 data points might be a lot, but I think right now we are just in the beginning, so it's really about just try to do the exercise. And I think that's what the regulator intended in the first place. You just need to start thinking about these things. And if you then decide, okay, that's not material for me, that's not material for my stakeholders, my investors, my insurance companies, then it's fine, I don't report on that. But please start to look at the topic in a standardized way.
Just steering the car back to the road. Before we get back to ESG and CSRD during towards the end of the webinar, but just Alex, we spoke about the rising complexity of deals due to regulatory measures and so on. Just looking in your direction and Timo's direction, is the technology alone sufficient in the existing deal structures, or does the industry need new deal structures to handle this rising complexity?
Am I asked first or Timo?
I hope you.
Because with regards to the deal structures which are needed to be more successful, to close deal faster, I cannot tell. What I can tell is that technology, as it is today and as we're seeing it, will be changing the way the due diligence part is steered significantly. So the complexity is actually not a big issue anymore. I mean, if you're talking about 1 data point or 1,000 or 100,000, it doesn't make a big difference, because technology companies like ours will bring more and more tools to life, which are decomplexing, which are like analyzing for the human being. And so therefore, what we as a technology company can do is, like, we can provide you with tools and agents and help, which brings your deal across and which makes things significantly more transparent and easy. Now, is a deal in a financial, in a structural, in a legal way, does that need to change? I hand over to the experts here in this round. Technology-wise, we can decomplex any kind of complexity now, and this is where AI kicks in massively, and where AI brings tremendously good results. I mean, that's what I can really add here.
Yeah, I don't think that the bottleneck will come from the tools being used. There'll be data rooms, documentary management, artificial intelligence, and so on. Obviously, that grows along growing complexity on the data points and transaction depth, if you like. But your question was, do we need different transaction structures? You said, right? This was the word you used. So, looking at the structures, I mean, obviously, an asset deal and a share deal are slightly different when it comes to the complexity. However, where we now heard the majority of the additional data and requests come from, lies again on the asset. And if you buy it in a share deal or in an asset deal, hopefully it doesn't matter to the extent the way you look at the underlying asset and property itself. So I think that alone will not be a big game changer. If you think about structures in a different manner, tokenization is often named, which I believe we've seen a couple of trials. I would add trials and errors more than successful trials. So I think that will take some time, at least in our legislation. But maybe first more vital steps, such as electronic land registries, such as electronic transactions, which can replace German notary systems. Those might be first steps in the right direction, which we do have in other countries already. I can tell that Alexandre doesn't agree, and obviously the more digital that part becomes, the less you guys have to do. So
no, that's wrong. That's wrong. That's we would really embrace this kind of change, because everything that we can get digital is helpful, you know. So we are building these kind of twins where you have this ongoing platform where you have all the to the asset belonging information, and this is not only documents, it's information as well. We're building these kind of things, so the more we can get from outside, the more we can connect to other systems, the better. But I just don't believe that this is going to happen, because I'm doing this since 20 years, and the way change came, it hasn't happened. So especially with regards to the land registers and everything. So people are trying to digitize that, and the notary. I mean, honestly, that's not what I'm seeing. So it's
no, I agree, but I think that's closer to be part of the immediate future than completely different transaction structures. Yeah, if you ask me what's more likely, that Germany will follow French and Spanish. In both countries, I've signed transactions in an electronic manner, not in front of a notary anymore. So will Germany and other countries follow such a modern footprint from a neighboring country? Or is it more likely that we will see completely new and reinvented structures, transaction structures? I think it's more likely that we will follow what we see in our European neighborships already. But let's see.
That would be good.
European neighborhoods is a good topic just to slide in organically to our next point, and we have some questions, but I will try to work them in. So speaking of the transaction trends before, we have also pulled some data, asked some investors, and 59% of the investors is a slightly bigger share than a few years before. Plan greater internationalization. So and here we tap in with the questions of our guests. Which markets and asset classes do you see to be the most attractive? And Timo, here we go into the detail because our guests want to know, how do you see the demand from investors for alternative assets? For example, healthcare. Is there equity available? I don't know if you can say something about the cap rates or investment yield that investors traditionally at the moment expect for international deals. So let's first keep it to that, because after that we have a question about the evolution of cap rates and investment yields in Europe, if possible more precisely for Germany, France and Spain. We will see if we can cover that. But
okay, I do Germany and the others can do Spain and France. Okay, look, I start with a question about alternative assets, right? And nursing homes and the health sector was mentioned there. Yes, that's one of the alternative assets, but I think others have been growing quicker. When you speak to the, let's say, private equity and more aggressive investors who enter Germany, who want to enter Germany, what they are looking for, you will hear since at least 2 to 3 years, beds and sheds. Yeah, so all subsectors of residential, all subsectors of sheds in the form of industrial, logistics, light industrial production, and so on. So translating that demand into the answer to the question around alternative assets, you can see that there was a lot of pressure into student housing, commercial living, serviced apartments, and you name it, under the beds headline. And under the sheds headline, I would say we saw a very similar trend in the light industrial, in the self-storage sector, and so on. So this demand grows, so does the supply. However, and now I mix and match a little bit the cap rate question, the established asset classes were hammered, as well as the subclasses and more alternative classes. So if you take logistics, for example, which was one of the preferred childs of investors prior to the change in interest rates and Ukrainian war and so on. So it came from what? A multiplier of 32, something like that. The most 31, 32, I would say, most aggressive transactions, hammered all the way down to a multiplier of 19. So lost more than a third. And logistics was not an exception here, but a very prominent example because so many investors were chasing it. That bounced back a little bit, but when I say a little bit, I mean it. Yeah. So that's still a long way to go, if ever, and ever is a strong word in that sense, to the yields and multipliers we've seen. There was a recovery last year when it comes to volume as well as to cap rates, but again, very moderate. I think office in January 25 in Germany sat at 4.6%, and on the peak it was sub 3%, right? So you can tell even after the 24 recovery, which we witnessed, it's still a very long way.
All right, great, thank you. So looking on internalization and cross-border deals, Christiane, Alex, maybe you could start, you both, and Timo quite possibly can jump in. But what are the main regulatory challenges for cross-border deals? Maybe Christiane, you could start with regards, especially on the ESG side.
Yeah. So thank you. Yeah, looking at Europe, I think we see, so when it comes to regulation, even though the overall direction is clear, in my opinion, of course, there's still a lot to do. And it's really about harmonization of standards, I think. And looking at Europe, so what we've been experiencing for the last 6-7 years is several regulatory developments happening at the same time. And like also, so for example, we see more like the horizontal type of regulation, the sustainable finance regulations, which is the aimed at directing capital flows towards sustainable investments, transforming the capital market. And it's really about, yeah, clarity, putting an end to greenwashing and disclosing. And so I see it more like a voluntary type of regulations, at least at the, now in the early years. So where it is, you don't need to comply with any of it. You don't need to have an Article 8 or 9 fund, but if you do, you need to meet certain requirements. You don't need to be in compliance with the taxonomy, at least not with all regulation parts. But if you do, you need to comply, with the requirements. So this is more like the horizontal type of regulation. And at the same time, we saw more and more kind of top-down regulation happening by the different regulatory bodies, by the member states, but also by, when you look at Germany and look at the states here, also even also some cities and so on. So, for example, we see more and more regulation regarding energy efficiency, EPC requirements, or where the regulatory body kind of says, okay, you need to replace your heating system and so on. And this regulation all happened at the same time, and it's not harmonized with each other, and that takes more and more time. And I think what is really, when we speak about unharmonized regulation, when it comes to the real estate industry, it's, for example, EPC requirements in Europe. I don't want to lie, but if I recall correctly, I think we have over 30 different frameworks right now in Europe defining the requirements for an EPC. And so this is really something that needs to change in the future, and where we really see, a burden on the market. So we spent, I think, 2 years ago, like a summer, two members of my team, they only compared energy classes of buildings in Europe. So that's something where we need Europe-wide standards.
Yeah, that's. I mean, as I said, with regards to the content, I will not be adding more than what the two already said. It's like for us, what we see is like there are tools for these kind of questions which are posed at the moment, and so with regards to comparing to do these kind of things, as long as the regulation is not the same everywhere, those tools are heavily used, and that's what we see as well. So these kind of activities are going on heavily, even though the deal flow is not tremendous at the moment.
And maybe adding on that, I think we urgently need the digital tools, and we need to have a database belonging to the buildings. So what we experience, speaking about, is the very ambitious reporting standards, but in practice we often see that it's, at least in Germany, still tricky to finalize the service charge statement. So because data is lacking, so the facility management, we did not read all the meters, for example. And so I think it's changing, but it takes too long now. And I think what really a big issue is, when also looking at transactions, that often not speaking about prime properties, but for example, speaking about logistics and or some older office buildings and so on. Each new owner starts, instructs a new property manager, facility manager, and so on. And they all start collecting the data again. No one is really using the data of the previous holding period. And I think that's really important that changes.
Christiane, you're singing my song. It's like, we know that, and I'm preaching that since many years. Maybe the good news here is that we have especially bigger players who have who are obviously starting to understand this, because it is a matter of being efficient, being fast, being transparent, and it's a matter of cost as well. So what bigger players start to understand is that if they maintain data on a longer period, that could really help. And so especially when if you have a platform where you just don't have dumb and dead data, but you have data that you can really work with, which is giving you constant feedback, then it starts being interesting. On the other hand, it's absolutely mandatory that those data are trustable, that they are not changed with regards to the past, for instance. These kind of things, it's like that's what companies already provide, and what has not been used so far, because people were like, okay, it was a matter of money as well. They said, during the holding phase, I don't want to spend that money, and when it comes to a transaction, then we have the whole pot of money, and then we don't care. And that's the reason, basically, why they start over and over again, instead of really maintaining, keeping, and the things. I mean, most of the asset that we're having in our data rooms is they are not transacted for the first time. So there should be a basis. A lot of them are like the 7th or the 10th time in our data room, and they start again. We have a whole department who are looking for data, structuring data, collecting data, That's a whole department, and they're starting over and over again. They ask, what do you have? We're getting an old data set of what we provided them like 4 years ago. And then we said, yeah, where the delta? And they're like, delta? I don't know. Let's go to the property manager, to the, and that is really ridiculous. I can only repeat this, you need to have, and this is possible today, the guarantee that the data which are on the platform are the current data, where the delta is currently put in, and so that you have the accuracy for the market.
Just speeding things a bit up, looking at our time left, I would like to throw in one question, looking at Timo especially, but Christiane and Alex, welcome to add. Do you observe that during the last years, the risk assessment among investors changed? Because looking at international incidences, you could think that things get worse.
That's for me a clear yes. Yeah. So focus on potential risks is definitely higher, but I think that's natural. Whenever you have a time window after risks just have materialized, let it be military risks and geopolitical risk we've seen, let it be a risk of a sheer jump in interest rates, which I haven't seen a single model which forecasted the rise of interest rates correctly. Yeah, they were all, including the ones I invested in, I have to say, they were all too soft. So it came substantially harder than even the wildest models assumed. So, and obviously this costs money, and this leaves bruises and pain in the system and kills a lot of business plans, as we have seen from the rise in insolvencies of developers, obviously, but also other parties to follow and still following. And that makes risk sensitive. Probably that's a good thing from time to time, to be reminded that markets and prices do not go only one direction forever. So but a clear yes from my side, more focus on risks than we've seen, let's say, 5 years ago.
From a sustainability perspective, I can only agree. So ESG or sustainability risks are not a risk category of its own, but they're kind of impacting the existing risk categories. And what we see, particularly with financial market participants, insurance companies conducting an ESG risk assessment of physical risk, climate risk assessment, for example, but also now more and more a nature risk assessment, and also looking at transitional risks. And we also, when it comes to real estate portfolios globally, what we really see is making a big impact right now on insurance companies who are stepping away from property insurance in very risk-prone areas. So, for example, I think in California and Florida, in the Netherlands, you won't be able to get a flood or extreme weather event insurance anymore. So this is also, I think now something which is really making a difference.
And technology-wise, I can tell you, and so it's really boring when everybody agrees, but it's definitely the case. Like the groups of people who have now who are constantly accessing the platform to analyze has become significantly bigger. So it's really per deal. You have far more people in the data rooms on the due diligence platform than you had in former years. But the interesting thing is, and this is why it's good when you're a couple of days older and long in the market. We had that already, like after Lehman crash, and so the subprime crisis was kicking in. Everybody was like, now we have to analyze risk, and so the amount of people populating the data rooms were like tremendous, and this was decreasing over the years, And now it's back. It's now what we see is really when there is a due diligence to perform, a heavy crowd, a lot of different people from different looking at the asset from different perspectives. What we haven't seen, not to that extent at least, in the last couple of years.
But I don't think that this is only a child of a rising risk focus. I think this also very simply has to do with resources. Because if you look at the big players, at least in Germany, I can tell, what they conducted quantity transaction-wise, let's say in 2023, I know it from the top of my head, because at Conrads beginning of last year, I had the biggest investors of the year 2023 on stage and interviewed them. So amongst them was big German insurance, big German public fund, big German real estate family office. And none of those parties had conducted more than 5 transactions in the year 23. Yeah, and that shows you, because obviously they haven't brought down the team sizes to the same extent, so they have substantially more resources and personnel to hand to look at each single of the very few transactions which were still happening. This will now grow back in the right direction, but I think that also counts into the equation you're sharing here, Alexandre.
Yeah, great that you say that. So now I can't contradict, because what we're seeing is that you have different parties, like really more experts, more lawyers, more this, more that, and so you got to pay those parties. You know, you have more the pre due diligence parties who are active and stuff like this. At least that's what we see, you know, and in the groups which are in the data rooms where we have access to and where we can talk about.
Yeah, but also the service providers sit on unused resources, so prices came down, right? I think so.
Let's not get into that discussion.
Okay.
We can focus on finding that out for the next time, but just throwing in one number for our participants before we wrap things up. Just maybe it's of interest, because we also conducted some surveys and found out that 42% of the investors see regulatory hurdles as the biggest challenge in cross-border or international deals. So just that's a 10% increase compared to 2023. So that shows maybe the rising complexity again. But just to wrap things up for our panel, just the quick questions. Looking at 2025 and on a broader scale in the next 10 years, what for you are the mega trends of the real estate market, of the European real estate markets, and how can investors prepare or adjust their strategies? Maybe not a question for quick answers, but we will try.
Shall I throw in something?
Yes.
My answer will not run through every asset class, okay? But I think if you look at this year and then the time span of 10 years, apart from the mega trends, which have often been reflected in investment strategies, yeah? So student housing as a mega trend, elderly living as a mega trend, and all that. That's going to continue. But I think more dominant or more maybe surprising might be those new flashes in the markets which are not based on such megatrends, because the megatrends are more foreseeable. Yeah, on demographics, you can do the maths, and you know how many students to expect and how many elderly people to expect, and so on. But there are a lot of unknown in other equations. So let's look at offices, for example. The return to the office after times of Corona and the liberalization of a work environment, mobilization of work environment, home office, moving into most of the big corporates. I think that's an interesting one to watch over the time window which you were opening, yeah, because the trends we see here are not easy to read or to predict. Obviously, the developers pray for offices to grow back. The advisors pray for offices to grow back. But on the other hand, you have a lot of bigger corporates who have understood that you can easily save money in that regards. The beliefs that the adjustment of office space to turn it more into a facility to meet each other and to communicate, and that you hence need breakout zones and more creative space, that might be right, but how can that ever be enough to overcompensate the shortage in demand if the liberalization, mobilization of a workforce does continue? And I think it's likely to continue because digitalization is continuing to move forward. You have AI moving into the same time window, eating up administrative jobs and repetitive jobs. And you have a battle for talent and workforce anyway. So the stricter you become and force your people back to the desk, the more problems you might have over the next 10 years to retain and to attract the most talented workforce which is left. So I think there are some big questions coming that way. Apart from the mega trends, investors are putting their money on already.
Yeah, maybe adding in terms of ESG, I don't like the term trend anymore when in connection with ESG. So what I think is really one of the focus topics in the next 10 years for the real estate industry, it's nature, it's protection and restoration of biodiversity and ecosystems. And that will completely change the business case of our industry. So we need more green areas, we need natural shading, we need nature-based solutions when it comes to climate resilience. And so I think nature will become an integrated part of any business case. That will be forced by regulation. It will also be forced by risk considerations. And I think looking at nature capital as one of the big opportunities for our industry, not only for the project developments, but really also for existing building properties. I think that's a topic to watch.
Big topic is technology. Technology eats a lot of energy. It needs a lot of infrastructure. It needs there is a lot of change. Indeed, the prediction with regards to office, I have no idea. The thing is, on one hand side, I'm like, okay, we need to bring people together because at the end of the day, it's a people's business. It's the best motivation comes out of teams and teams sitting together, working together, going through hard times together, going through good times together. That's on one hand side. On the other side, we're a tech company. We are working in some parts of our company up to 100% remotely, and it works. And it is efficient. It is smart. It is those people are good. They are good managed. So the different styles. With regards to energy, I'm seeing a lot of demand in the next years coming. So where do we get all that energy for all these tools, for all this digitization from? How is that dispatched? How is the infrastructure for that? Where are the people sitting who are using these things? So there is a couple of questions which I'm asking myself and where we're preparing Drooms for. And it's going to be interesting. None of us has a glass bowl to predict really, but we're living interesting times and times where the future is changing dramatically compared to what we had so far.
Thank you. Thank you, Alex. Thank you, Timo. Thank you, Christiane. So just wrapping things up, thank you everybody for joining. You have heard some mega trends to watch, probably especially to watch or to have a look into, because it's super interesting, is the Omnibus Directive for CSRD and also the Compass strategy of the EU, which maybe sheds a light on the way we are going over the next few years regarding ESG. But for now, let it be it. Thank you everybody for joining and have a nice day. Goodbye.
Bye everybody. Thank you. Bye-bye.
Thank you.